In this example, we look at the sale of immovable property and the application of Section 35A. Important, guys, if you've not yet studied capital gains tax, this might be a little bit confusing. I don't want you to focus too much on that. I want you to focus on how we treat the withholding tax. That's the point behind this lecture example. So Mr. X owns a holiday home in Cape Town, South Africa. Mr. X is 50 years old. He originally purchased the holiday home at a total cost of 1.2 in 2002. So that will form part of his base cost. In 2006, Mr. X repaired the holiday home for 100,000 rands. That is not base cost. Repairs are not added. All of this you'll study under CGT. In 2007, he added an extra balcony. That's base cost. He sold it for 3 million. You may assume that he had other income from a South African source of 500,000 and income from the USA of 400. Then I ask you, you sold it to Mrs. Y, right? So Mr. X is the seller and Mrs. Y is the buyer. Mr. X is, and what is the tax for Mr. X if he's a resident? So guys, first of all, Mr. X is the seller, the person receiving the money. This section 35, here A, here, only applies if seller is a non-resident. Right, so for situation A and B, I want you to see there's no withholding tax for A. Right, and B you'll see is that they say the answer is identical. Right, so for A, there's no withholding tax, and in B, you'll do a normal calculation. So I'm just going to quickly talk about it once. I don't want you to look at that for really the rest of the example to be your focus. You add the income received, you have to do a capital gains calculation, which is proceeds less base cost. Right, there's annual exclusion, all of these things. This is all things that you should have seen at least sometime in your life. We'll go in for a lot of detail. So I want you to see, calculate the taxable income, tax per tables, deduct the rebate, and that's it. Right, that's the situation A and B. Situation C. Now Mr. X is a non-resident, so section 35A will apply, and Mrs. Y is a resident. He did complete his tax return within 12 months from the end of the year. Okay, so the first thing I want you to see, C, we do withholding tax. 7.5%, there is the withholding tax, 225,000 rands. Then we do the income tax calculation. Now this income tax calculation, I want you to see, is exactly the same as it is for a resident, which you saw in the first bit. And that makes sense because residents and non-residents have mostly the same rules. But now important, because this person completed his tax return within 12 months, that withholding tax that we saw in part C, that withholding tax will be allowed as a deduction from your prepaid taxes, so it reduces your normal tax. See now in situation D, he's still a non-resident, but now he did not complete his tax return. So D, there's the withholding tax, and that's it. Because the person didn't complete his tax return, there's nothing further to do. Right, so this process that you see here, this is what happens if you complete your tax return. So even if they did for some reason complete the tax return, let's say the following. Let's say they completed the tax return more than 12 months later, but they did complete it. Then you would see this exact same tax calculation, but this withholding tax over there would not be allowed as a deduction. Thank you very much.